video explains how to read and interpret the AgriProfit's backgrounding enterprise analysis, Drylot and Grasser, using an example of the report. In particular, it explains what is covered by the report, why this is important, and how to interpret the report information. The video concludes with a summary of key takeaways and contacts for any further assistance. Backgrounding is the second stage of beef production. In a typical backgrounding enterprise, weaned calves are placed on feed in Drylot pens and can also be grazed on a pasture from 6 to 12 months of age. The AgriProfit's individual pen report summarizes all sales and expenses for each pen and then aggregates to an enterprise level, resulting in the Backgrounder Summary Report. The generated information for feeder sales, different types of costs, and economic performance allows producers to examine the efficiency of feeding and management production practices. These indicators can then be compared with other producers and industry standards or benchmarks to gain additional insights. The report information is also important for communicating with banks and other financial institutions to negotiate loans and investments. We will concentrate primarily on the Drylot individual pen report, which is the basis of the AgriProfit's Backgrounder Economic Report. The specifics of the Grasser enterprise will be explained when it's appropriate and necessary. The individual pen report consists of 4 sections: revenue, production costs, efficiency measures, and physical performance. Let's examine the revenue section first, using an example of the report. In particular, we will look at a Drylot pen with 145 feeder heifers placed at 550 pounds per head, fed for 78 days, and then sold at 687 pounds per head with a gain of about 137 pounds per head. There are no deaths reported. The revenue for the pen is the market value of weight gained in that pen and is calculated as the difference between the dollar value of animals sold and dollar value of animals placed. It is reported per 100 pounds of gain, per head day, and per head sold basis. Each unit or production base reflects a particular view of the analysis. We will use primarily the dollar per 100 pounds of gain because this measure lends itself better as an indicator for comparisons between pens. In this example, the pen revenue is $160 per 100 pounds of gain. To see if the revenue is adequate and provides enough returns, the producer needs to compare it to the related expenses. This information is given in the cost section. The cost section summarizes critical production cash and non-cash expenses, such as feed, bedding, veterinary, labor, and depreciation. In this example, we can see that feed is the major contributor to the variable costs, accounting for about 45% or $49 per 100 pounds of gain. Together with the bedding cost, they account for about 50% of variable costs. In a Grasser enterprise, we would see a grazing cost calculated as the product of pasture grazing capacity, expressed by animal unit months, and the pasture rental rate, expressed by market value per 1 animal unit month. The second major contributor to the variable cost is labor, both paid and contributed. It accounts for about 17% of variable cost, or $19 per 100 pounds of gain. In this example, trucking and marketing is the third major contributor to the variable cost, accounting for about 10% or $10.50 per 100 pounds of gain. Together, this 4-item cost cluster accounts for about 75% of variable costs, implying the cattle feeding, labor, and cattle shipping methods are major drivers of the production cost and, consequently, the economic efficiency of the enterprise. The fixed cost section consists of items such as share lease cattle payments, taxes and insurance, depreciation, and paid capital interest. In the example, the depreciation cost is the largest source of fixed cost and accounts for 81%, or $15 per 100 pounds of gain. AgriProfits uses the straight line method to calculate the depreciation costs for buildings and machinery, and then allocates a proportion to a specific pen based on the number of head days of use for the facilities. Together, the variable and fixed costs account for $127.72 per 100 pounds of gain. Subtracting the total production cost from the pen revenue gives the pen net return of $32.28 per 100 pounds of gain. In addition to the net return, AgriProfits calculates gross margin, which in our example is $62.78 per 100 pounds of gain. Gross margin accounts only for the cash portion of cost that excludes unpaid labor and depreciation. Gross margin shows the amount available to cover the depreciation cost, principal payments, and owner's withdrawals. The profitability ratio is calculated by dividing the net returns by total production cost. In our example, the profitability ratio is 25.3% and is an indication of a relatively good efficiency position. Each pen report also provides a summary of break-even prices to cover different types of costs and the margins that are earned above the break-even price. AgriProfits calculates a break-even price as the sum of the feeder replacement cost and the specific cost item, such as feed, variable or total, divided by the weight of the sold feeder. In this example, the break-even price to cover the total cost is $152.87 per 100 pounds sold, meaning that to cover the total pen cost, the feeder price has to be equal to at least $152.87 per 100 pounds sold. In the same way, the break-even price to cover only variable cost is calculated by dividing the pen variable cost by the feeder sale weight. In this example, it is $149.17 per 100 pounds sold. Margins show the returns above the corresponding break-even price. The margin for feed cost is $22.10 and shows the returns after covering feed costs. In this example, the pen's margin for total cost is $6.43 per 100 pounds sold. It shows the amount earned after covering all total costs. In the example, a positive margin for the total costs indicates the pen was profitable in the reported period. The physical performance section covers such measures as days on feed, average daily gains, feed conversion efficiency, and feed utilization on a fed and dry matter basis. In this video, we will cover selected physical efficiency measures and direct you to the AgriProfits Report interpretation notes for a more comprehensive discussion on other measures. In this example, for the reported 78-day feeding period, the average gains were 1.75 pounds per day, or about 137 pounds per head sold. The corresponding feed conversion efficiency on dry matter is 8.9, meaning that about 9 pounds of feed dry matter is required to produce 1 pound of weight gain. Having calculated average daily gains, feed conversion efficiency, and other physical performance measures, the producer can compare the results with industry and technology standards. For feedlot operations, the feed conversion ratio runs between 4.5 and 7.5. A lower number is desirable. In this example, the feed conversion efficiency exceeds the upper limit of this standard by 1.4 units, which indicates there is some room for improvement. Let's look at the feed utilization section. It reports the feed usage in terms of market value in dollars per ton, and feed use in total tons as fed and amount per day on a dry matter basis. In the example, the Drylot pen uses 17.7 pounds of feed per head per day on a dry matter basis, or 2.6% of body weight. We can also see the producer uses a silage grain type ration, 71% silage, 29% grain. Because feeds are a major component of the production cost, it is important to examine feed rations and feed intakes to control these costs. Let's briefly summarize our example. We saw that the analyzed Drylot pen was efficient given the specific feeder and input price conditions. The revenue from sold cattle exceeded the total production costs, with a resulting profitability ratio of about 25.3%. Put differently, every dollar spent to raise the cattle in that pen earned about 25 cents of net return, indicating a relatively good efficiency position. The calculated break-even price, however, was $152.87 per 100 pounds sold, with a margin of $6.43. This means a relatively small change of feeder price can affect the pen's economic efficiency. Both the average daily gains, 1.75 pounds per head, and feed conversion efficiency ratio, 8.9, indicate there are still some areas for improvement. In our example, the producer might want to examine the existing cattle feeding and maintenance methods and compare them with industry recommendations and practices. The feed utilization and other sections of the report supply indispensable information for such an in-depth analysis. This ends this module. For any questions or additional information, refer to the Government of Alberta Agriculture and Forestry landing page. AgriProfit's links may be found under the Agriculture Business and Economics sections. You can also contact AgriProfit staff directly at 780-422-4088.